Hello and welcome. In this video, we will discover everything you need to know about the economic crisis of 2020 to 2021. The next years will be challenging years. Yes, I'm talking about the pandemic that's taken almost every country's and one international conveyance by a blow, affecting their social and economic behavior vastly. With businesses shutting down and unemployment increasing by the hour, recession is inevitable in America and in the rest of the world. What is to come exactly in the future is still unpredictable. But one thing's for sure, that this recession is going to be worse than the global recession that came in 2008. Let's see the facts, how you can prepare and thrive during this recession. But just before, make sure you subscribe to the channel and don't forget to download your free book on financial freedom by clicking on the link in the description below. How bad is the economic crisis in America? Supply chains have broken. Factories are closing, and workers have been quarantined, resulting in disruption of supplies. Travel and tour industry has come to an abrupt halt with the fear of the highly contagious COVID-19. Retail and consumer businesses are crippling under the pressure, and there is a wide possibility that they might go bankrupt. This will result in downgrading of corporate debt and impairment of the balance sheets of banks. As is evident, COVID-19 has widely affected both sides of the economy, supply and demand. The supply of goods and services is falling short, as the factories and offices are being shut off. Although demand has disrupted as the public is being asked to self-isolate and a ban on socializing has been put in many states. At first, it was widely assumed that this crisis would rather revolve in and around China. The world would see some spillover effects, but nothing it couldn't tackle with some policy easing. But no one expected the situation to turn into a pandemic as deadly for the economy on a global level as it is now. However, it soon became clear that COVID-19 was not just confined to China and its borders. Both the virus and its economic effects can be felt far and beyond. The economists so made a revised forecasts. A V-shaped graph was presented, where the economy goes spiraling down for a short period and goes straight back up with businesses booming in no time. But given how far blown the pandemic already is, this approach too looks wildly untrue. You'll be surprised to know that similar forecasts were made at the time of crisis in 2007. At the time of the subprime mortgage crisis, it was initially assumed that this was a rather minor problem affecting only the US and could be easily managed, but is that what happened? I'm sure we don't need to be reminded of what the country went through, but if only people could learn anything from history. While this crisis is varying in its origins from the last one, it is following a similar pattern of collapsing consumer and stock market confidence, resulting in a downgrade of growth, demand, employment, and incomes. Greg Dacko, the chief U.S. economist at Oxford Economics, claims that a recession is inevitable. He also forecasted 2 consecutive quarters of economic decline, with output falling 0.4% in the first quarter and 12% in the second. This would be the biggest quarterly contraction in America's history. Talking about history, most recessions usually begin in the goods-producing sectors of the economy. However, this is a first-of-its-kind recession that will affect the service sector most, and that is worse. Why? It's simple. In a service sector-dominated economy, much of the lost business is never going to be recovered, as opposed to other sectors. Here is a simple example. If you're unable to go for your weekly family dine-outs because of the fear of COVID-19 at your favorite restaurant, it's highly unlikely that you're going to go to that restaurant twice as much once the lockdowns are over. However, the good-producing industry will not lose all its business forever. Yes, there will be a timely crunch where there will be little to no sale. But in the times to come, their goods will sell out like hotcakes. This is one reason why manufacturers build up a stock that can be later sold when conditions improve. Well, if you look at service providers such as restaurants and barbershops, things get ground to a halt, and that business that is once gone is gone forever. Most economists, such as the chief of U.S. economists Michael Gapin, are concerned more about small-scale businesses than large-scale. While large-scale businesses might go into debt or have low profits in the near future, but in times to come they will eventually thrive, while the small-scale businesses will go bankrupt altogether. He says that his concern doesn't revolve around United Airlines or other small and medium-sized corporations that issue bonds, but he's more concerned about the restaurant at the end of the street. They are the ones more likely to go bankrupt. At this time, where most states are locked down, restaurants are surviving by serving takeouts or deliveries. Take an example of a random restaurant. On a typical day at lunchtime, you'll find 15 employees working, 8 employees in the kitchen, with 5 working as servers, 2 bartenders, and 1 manager in the front of the house. But in conditions that prevail today, these restaurants operate with less than half their staff with no one out front, which means the kitchen employees are cut to half and the rest of the kitchen staff and servers are all laid off. All in all, restaurants and airlines would be among the most affected industries among the service-providing sector. Sectors like healthcare, pharmaceuticals, and chemicals will follow behind. The least affected of the industries would be telecommunications, software, and the steel industry. But what is more concerning is the fact that whatever the industry, the rate at which people are getting unemployed by the hour is beyond our imaginations. Major forecasts of recession. Major banks on Wall Street have been issuing dire forecasts about what's to come due to the pandemic that's been causing wreckage both in terms of people's health and the country's wealth. Goldman Sachs economists on Friday forecast an unprecedented 24% hit to U.S. second quarter GDP, following a 6% decline in the first quarter due to coronavirus. The bank also expects unemployment to surge to 9% and full-year GDP for 2020 to fall 3.8% on an annual average basis. Bank of America warned late on Thursday that a recession due to the coronavirus pandemic is already here. Jobs will be lost, wealth will be destroyed, and confidence depressed, the bank's U.S. economist Michelle Meyer wrote in a note, as the Bank of America also forecasted the economy to, quote, collapse in the second quarter, shrinking by 12%, with GDP for 2020 taking a 0.8% hit. Morgan Stanley warned investors of the same thing. Global recession in 2020 is now our base case, the firm's chief economist Chetyan Aya wrote in a recent note, predicting global economic growth to slow to 0.9% this year, the lowest level seen since the 2008 crisis. Deutsche Bank predicts that the U.S. economy will contract by 12.9% in the second quarter, with the coronavirus-driven declines set to substantially exceed anything previously recorded going back to at least World War II, according to a note Wednesday. UBS similarly sees a massive contraction of almost 10% in second quarter GDP, while also predicting a deep recession in the first half of 2020 due to the coronavirus pandemic. But most of the economists at the big banks listed above still predict the economy will rebound later in 2020 or by 2021 at the latest. The Organization for Economic Cooperation and Development recently slashed its forecast for 2020. The forecast stated growth by half, from 2.9% to 1.5%, with an assumption of a sharp V-like recovery pattern. Needless to say, the first round of forecasts by the Organization for Economic Cooperation and Development have been too optimistic, since they incorporated the widely held but likely incorrect assumption that the recovery would follow a sharp V-like pattern, a first quarter hit that is immediately offset in the second quarter. As the days unfold and the pandemic grows beyond our imagination, a U-shaped recovery seems more likely. Not only this, economists are also thinking about a possibility of an L or an I, which means a market that remains flat or in free fall for some time. What is the government doing to protect Americans against the recession? America's central bank reserve reduced interest rates, which claims to bring back a $700 billion profit in the coming weeks of pandemic. This is the second time after 2008 that they cut off their base interest to almost a zero. The government also restarted a money printing program that was last used during the global financial crisis in 2001. It claims to release the pressure put on the economy by the coronavirus pandemic. Government has also decided to pay checks for Americans. As per the statements of the Treasury Secretary, an average check for a family of 4 members will be $3,000. But if you think this is the right amount to thrive this pandemic, then you are wrong. Imagine, would this amount be enough to pay rent in New York City, or any other high-maintenance state for that matter? It won't take long to run out in any part of the country. Economists say that although it's not useless, it's more like a band-aid. It'll cover the wound till you reach the hospital. But there is where the bandage will be ripped off, and that will hurt. The surgery after will be costly, and may even cause more pain, and take more time before it heals completely. However, this is all the government has promised to do as of now, to keep the curve as shallow and short-termed as possible, although it seems highly unlikely. Conventional policy measures which work otherwise don't stand a chance in this time of need. Policies such as cutting the cost of borrowing or reducing taxes tend to work better when there is just demand shock. But since this pandemic has disrupted both supply and demand chains, there is a limit to what the government can do. How to survive this recession? Keep in mind that the recession itself is inevitable. You will be affected at all costs. You can't dodge it, but you can surely prepare for it. Steer clear of loans and pay them off if you have any before the crisis hits hard, especially if they are consumer loans. Look for unique and new sources of income that work when conventional income sources get disrupted during the crisis. Make sure to spend on needs more than luxuries and keep your focus on savings during this pandemic. Also, it is not the right time to be investing all your savings in gold, property, or stock. 1. Though gold is considered the safest when hit by a crisis, investing all your money is risky. Why? Because A. It's not liquid money, and B. This precious metal is heavily taxed when sold or purchased. Keep at least 30% of your investment in cash. 2. Next in line is trading stocks. During the time of crisis, stocks are at an artificially high price, which means investing will result in loss in the long run. Most stock owners find this a good time to sell off all their stocks, but that too is not the best bet. If you want to play safe, secure a good amount of valued stocks and sell the rest for profit. 3. Property buying at the time of crisis is a no-go, especially if you're buying it on credit. The banking system is the most fragile at a time of crisis, which makes your deal with the bank as fragile and uncertain. However, if it's the other way around and you're selling your property, there's no better time than this. Above all, keep calm and make well-calculated risks, because God knows this crisis may disrupt the economy far worse than the previous ones. If you enjoyed this video, please like, share, comment, and especially subscribe to the channel. You're also free to receive the new book, 5 Steps to Reach Financial Freedom, by clicking on the link in the description below the video.